under today's section, we will talk about the questions that you have gotten for from your chapter A. So make sure you watch the recordings that I've uploaded on your first chapter, and afterwards you make sure you do this workbook. So from this workbook, I've included all the questions that you can get, some of the questions that could be tested in your exam from your chapter A. So here, the first, if we get started off, the first question that we have is, a director of a limited liability company in Sri Lanka uses company funds to pay for personal family holidays. According to the business entity concept as described in the source, how should this transaction be recorded in the company's financial statements? So I hope you all remember when we started the first unit, in that I explained about the business entity concept. So in that it said, you should know, so you have your business and also you have your owners. So keep in mind, in the business entity concept, it said the business and the owner are two separate elements, that they are not the same. Okay. So here, if the owner is taking something out of the business, we still have to account that. Now here, that's what's happening, right? He's using some of his funds for his personal use. And also, if he's putting more money into the business, we still have to count that. Okay, so usually keep in mind, we prepare accounts for the business, not for the owner. So based on this, here the most correct answer should be, we have to record that as drawings, which reduces the director's equity, because he's taking something out of the business. Now equity is what belongs to the owner. Okay, so net profits, the capital that he has invested would belong to him. He will be taking those out of the business for his personal use. So here, first one should be answer number C. Next, we move on to the next question. We have a partnership and a limited liability company both wish to purchase a new office building in their own name. Based on their legal status as defined in the source, what is the key difference in their ability to do so? Okay, so here I hope you remember the differences between partnerships and limited liability companies. So we'll see one by one what are the key differences. Both can own property, but the LLC requires shareholder approval. LLC stands for letter of credit. So we'll keep that for now. Next, we have the partnership must buy the property in partners' individual names, while the limited liability company can own the property directly. Yeah, we'll keep that also, and we'll check the other answers that we have. Other answers, the LLC must get a loan to buy the property, where the partnership can use partner funds. And also, neither entity can own property directly, it must be held in a trust. So here, the most correct answer should be both can own the property, but the limited liability company requires a shareholder approval. So here, you don't need a shareholder approval to purchase a property. Keep in mind, if the company, whoever is running the company, if they have decided that it's beneficial to purchase, then you can purchase. So A won't come. B, the partnership might buy the property in their partner's individual name, while the LLC limited liability can own the property directly. So that is true, no? Partners usually, you all know, they have an unlimited liability, right? Now, if the partnership is, say partnership is bankrupt, then the partners have to use their own funds to pay for the bankruptcy, to cover your liabilities. Then they have to use their own assets that they have. So when they are purchasing, they'll purchase in their individual names. But limited liability company, they can purchase whenever they want. So here the answer will be D1. D, we'll check the other two as well. The limited liability company must get a loan to buy the property. There's nothing like that. They can use their own funds as well. Then neither can own property directly. It must be held in a trust. There's nothing mentioned like that. So anyone can purchase the property. So here answer number 2. Answer is B. We'll go to the next part. Then in the third question we have, a partnership is unable to pay a significant business debt according to the principle of unlimited liability described in the source. What is the potential consequences of the partnership? Remember I told you Now, usually in a partnership, there is an unlimited liability. But in a company, there is a limited liability. That means if the owners who have invested in a company, if it's bankrupt, the shareholders won't have to pledge their assets. So the company won't take the shareholders' assets and pay for the liabilities, the bankruptcy. But in a partnership, keep in mind, if a partnership is bankrupt, to settle the liabilities, the partnership can take the partners' assets as well, because partners have unlimited liability when they're carrying out a partnership. So here, according to this, first we have the partners are only liable for the amount they originally invested. That is not true. They are liable for the whole business activities. Next, the partners may have to use their personal assets such as their home, cars to settle the business debt. That is true. That's what I explained just now. So here, for this, it should be the answer. B, we'll check the other two as well. The debt forgiven because the partnership, the debt is forgiven because the partnership is not a separate legal entity. No, there is nothing like that. Okay, so next we have all the partners who made the decision that led to debt is personally liable. Only partner who made, no, all the partners are liable because everyone carrying out with the agreement with the intention of earning profits. So everyone is liable to pay for the bankruptcy to settle the part. So if they're bankrupt, that means they have to settle liabilities. In order to settle that, all the partners are liable to settle for such. Next, the fourth one we have the source identifies investors, lenders, and other creditors as. So keep in mind, investors, lenders, and other creditors are your main stakeholders who go through your financial statements. Who will be going through your financial statements to take. They are the ones who will be taking a decision. Investor, whether to invest in the company. Lenders to provide you money. And other creditors basically supply you goods. So these are the capital providers of a company. Okay, so here we have A, because they are only stakeholders interested in a company's profitability. We'll keep that because they have the most sophisticated understanding of financial statements. There's nothing like that. Everyone who goes through a financial statement, they'll potentially understand. Next, because they provide capital to the company but cannot demand custom tailored financial statements. That's true, no? So here, those are the ones who provide capital to your organization. So they are the ones who will be mainly going through your financial statements. So for the fourth one, it's the answer C. We'll move on to the next question then. If the accounting equation is stated assets equals liabilities plus equity, according to the definition in the source, what does the equity component mean? So equity is, as I told you before, that's the stake that belongs to the owner. Okay, so here it says total cash invested into the business by its owners, the market value of the company share, the total value of assets owned by the business, the owner's residual stake in the business assets after all debts have been settled. That's true, right? Basically, from your assets, when you deduct the liabilities, that's what belongs to the owner. That's your equity portion. So here, for the fifth one, it's the answer number D. Next, we have the source lists the statement of change in equity as the key component of financial statement. What is the primary purpose of this specific statement? Now, later on, we'll be learning about the statement under your financial statements. But here, keep in mind, I have explained this as well. In your statement of change in equity, you record changes that happen to owner's equity. Okay. So here, if you go through to show company's total assets and liabilities, that is wrong. To report the company profits and losses, that you record in the P&L. So here, this is shown in your assets and liabilities. To detail how owner's stake of the company has increased or decreased, that is shown. What belongs to the owner's stake, how that has changed, you show. Answer number C. To show the cash flow inflows and outflows from operating, investing, and financing, That is from your cash flow statement. This you'll learn, going ahead, don't worry. Seventh, we have in December, company provides services to a client who agrees to pay in February for next year. According to the accrual basis of accounting described in the source, when should the company recognize this revenue? Now, remember I explained the revenue recognition concept or realization concept. So, according to accrual basis, when the goods have been provided to the customer, then you can record it as an income. Maybe it doesn't matter whether he has paid us or not. Now, if you take the company provides the services to client who agrees to pay in Feb, in next year, according to accrual basis of accounting described source. In Feb, when the cash is actually received from the client. In December, when the service was provided and the revenue was earned. Yeah, so here in December, company provides the service. Now, when they provided the service, then at that point, you can record it as an income. But you still haven't gotten the money. So, in Feb, you are getting, so you can account this as a receivable. So, in December, then, you can account it as an income. So, that's the answer for the seventh one. But according to, if this is a cash basis, then you record in Feb. Because when the cash is received for the sales income, then you record it as an income. Then we can move on to our next question. So in the eighth one, we have the source identifies the going concern principle as a fundamental assumption in accounting. How does this principle directly affect the valuation of company assets in the statement of financial position? So I hope you remember going concern is your main assumption. What that means is when you are running a business, you should run with the intention of continuing. So if there is a harm to, if there is a violation, if this assumption is uncertain, then we have to show that in the statement of finance in our publications as well. When we are publishing, we have to say that it's going to be bankrupt soon. Okay. Here we have, it requires all assets to be valued at the current resale price. No, there's nothing like that. It assumes that the business will continue operating, allowing assets to be valued based on their ongoing uses and their immediate liquidation value. We'll keep that. It forces the company to revalue its assets for the fair value at the end of the year. There is nothing like that. It has no impact on asset valuation, but affects liabilities are reported. How liabilities are reported? There is nothing like that. Here it says it will continue operating for the future, as I said, allowing assets to be valued based on their ongoing use rather than their immediate liquidation value. Yeah, so now what that means is, so that should be the answer. Now, if we were to liquidate, sometimes we would have to sell it at lower value, right? Say we are going to be bankrupt soon, then we have to settle our liabilities that we have now. To settle our liabilities, sometimes now say you have your motor vehicle value at 1 million. But people know that you are going to be bankrupt soon and you're in a hurry to make money. So then sometimes you might have to sell it at a lower price. Maybe for 800,000 you have to sell. Because you are going to be liquidated soon. Or you are going to be bankrupt soon. So here the answer is the 8th one. Next, according to the source, what is the specific duty does Companies Act number 7 of 2007 impose on a company director regarding financial statements? Okay, so we'll see what so this Company Act say regarding directors. Directors are only required to hire qualified accountants to prepare statements. There is nothing like that. You don't have to be qualified to be hired as an accountant. Directors must ensure that statements are profitable to attract investors. We'll leave that for now. Directors must formally accept responsibility for the accuracy and compliance of the financial statements by signing the statement of compliance. We'll keep that also. Directors must file the financial statements with the accounting and auditing standards monitoring board. So no, you don't have to file the financial statements with that board. You get an auditor, you do the audit, and then you publish that. But here, they should accept their responsibility for the accuracy and compliance by signing a statement of compliance. That should be the answer. So when they are conducting, they have to conduct in a proper manner, in an ethical manner. So by taking responsibility and ensuring that the statements that are being published are accurate and doesn't mislead any investors or anyone. So here it should be the answer C. We can move on to the next section then. A company's financial report includes optimistic, unverified management forecasts, its main statements to make performance look better. Which component of faithful representation is being violated? Yeah, here I hope you remember when we were doing qualitative characteristics, we have two fundamental, relevance and faithful representation. So under that we have faithful representation is where you can't overstate or understate values. We have to present faithfully. From the word itself you can get an idea. So here it should be, so we had in that three sections under faithful representation, completeness, neutrality and free from error. Neutrality is you can't be biased basically. Now here what has happened is we have included optimistic, unverified management forecast to make performance look better. Maybe to a higher profit. We are being biased, right, towards the company. Then we are violating this neutrality concept. That means we are being more biased. Okay, so it should be answer number B. The external business environment does not consist of, so we have political, we also have technological. There is no thing called structural. You also have economic. So in your external environment, so that's something basic. Next, which of the following statement is true regarding Companies Act number 7 of 2007? The Companies Act number 7 of 2000 requires the company to give a view on the financial transactions and financial statements and of the state of assets in the monetary and non-monetary value. We'll keep that for now. The Companies Act number 7 of 2007 applies for sole trade, proprietorship and partnerships. No, that is wrong. It applies for companies basically. The Companies Act number 7 of 2007 is not the main piece of legislation governing companies in Sri Lanka. No, that is the main act that governs the companies basically. The Companies Act number 7 of 2007 requires companies to prepare financial statements that give true and fair value of a state of affairs of the company as at the balance sheet date and the profit or loss of the income external. So here that should be the most correct answer. Now, sometimes keep in mind you might have something similar answer, somewhat similar. Now here Balana, if you take the first A, it gives a view on financial transactions, financial statements and state of assets. That's all somewhat similar, no? But here the most correct one is answer number D. It requires the company to prepare financial statements with a fair view of affairs on the balance sheet and the profit or loss. Next, the main responsibility of a CEO, Chief Executive Officer. Attainment of the company's vision and business growth and profitability and service level objectives through leadership. Control of the company's affairs, alert all stakeholders towards obligations, prepare financial statements and communicate to chairman, provide directions in the internal audit team and implement internal control systems of the organization. So I hope you remember I explained the hierarchy. On top, we are the board of directors. They appoint a CEO to run the organization and activities. So his main activity is He has to attain. Now, normally when you're running, you run with a mission. Vision. So he is on the top. His main purpose is to attain that mission and the profitability and service level objectives through his leadership. So here the main object responsibilities, it should be answer number 8. Next, if you take 14, select a suitable statement which describes the role of functional manager in an organization. Yeah, a functional manager enter daily transaction in the accounting system. So that's a function of an accountant. Apply expertise to realize plans of senior managers. So that's true, right? Senior managers give the functional managers what to do. Those plans will be implemented by your functional manager. Invest to initiate an organization, that is false. External control over the others on behalf of owners, that is also false. There's nothing like that. Next, which is the following statement illustrates the basic accounting equation, that is through your SOFT. So in that it shows the basic accounting equation, assets equal liabilities plus equity. Equity shows the equity component. P&L shows the. Okay. Next we will talk about the next question that we have. Which of the statements are correct with relevant to conceptual framework of financial reporting? Okay. So we have to identify the correct statements. So if you take the first one, income leads to increase in assets, decrease in liabilities. That is true, no? Due to an income, your assets will increase and liabilities will reduce. Next, expenses lead to decrease in assets and increase in liabilities. That is also true. Due to an expense, now when you are settling an expense, expenses will reduce. If you haven't paid that expense, liabilities will increase. The conceptual framework of 2018 has specified 3 features of an asset: right to use, potential economic benefit, and control by the entity. That is also true, right? You have the right to use that asset and it will create potential benefits in the future. And also the entity has the control to use that asset. So here all 3 comes. These 3 comes. Next we'll take the 4th one also. As to the conceptual framework, a present obligation that exists as a result of past event and obligation to the external parties of an entity are 3 criteria to be recognized as a liability. So we'll see these 3 criteria. Exists a result of a past event, that is true. And you have an obligation towards the external party to repay back that amount. That is also true. And also you have a present obligation. You have obligation. Now say you obtain a bank loan from a bank, you are obligated to repay back that amount back. You have to repay back that. So 4th also comes, it will be also answer number 4. 17, you have to identify the 2 fundamental characteristics. So I hope you remember the 2 fundamental characteristics are faithful representation and relevance. So relevance and faithful representation. So that is easy. You have fundamental and enhancing. Enhancing ones are verifiability, understandability, comparability, and timeliness. So I explained that in our first chapter. Next, which is the following is not a contributing factor towards faithful representation. So as I told you previously also, we had a similar question. Neutrality should be there. You can't be biased. And everything should be complete. All when you're publishing, you have to publish all the relevant information. And you have to try and minimize the error. These 3 should be there. Consistency, there's nothing like that in faithful representation. Next, you have the conceptual framework. Key concepts can be split into 4 categories. Which of the following is not a category? Here, qualitative characteristics that comes. Reporting entity, is also a reporting entity that counts. Definitions of definition and recognition and derecognition of the elements also comes. There is no such thing called duties of internal and external uses of accounting. So it should be answer number D for 90. There is no such thing called duties of internal and external uses of accounting. Then we can move on to the next question. Information to be relevant in accordance with the conceptual framework. Keep in mind, relevance is basically, if it's relevant, it will create an impact on the decisions of your users. So if you have provided relevant information, keep in mind, through that you should be able to predict what's gonna happen in the future. You should get a predictive value, and you should be able to confirm that it had actually happened. Now, for an example, how basically debtors got bankrupt, you show it as a note how this bankruptcy happened. Then from that they can get a confirmation that this has actually happened. So it used to be relevant if it's predictive value and if it provides confirmatory value. So for 20th, it should be answer number 8. Which of the following is one of the main purposes of financial accounting? So I hope you remember. So the main purpose of financial reporting is you provide information for your stakeholders, mainly for your investors, lenders, and other creditors, for them to make a decision. So based on that, you have, it should be answer number B, provision of information for decision making of stakeholders. Next, you have which the following statements are correct in relation to business entity concept. So I hope you remember. I told you business entity is where it states that the business and the owner are two separate entities. The business entity concept is applied only in entities with legal personality. No, it applies to anything, any business that you're carrying on. Could be partnerships, companies, anything. Business entities are treated as separate from their owners. That is so. As I mentioned, all transactions should be recorded from owner's point of view, not from business's point of view. That is wrong. You record from business's point of view because you prepare accounts for the business, not for the owner. So here all transactions should be recorded from the business's point of view. That is correct. Should be 2 and 4. Answer number 6. Next, corporate governance is a system by which companies and other entities are directed and controlled. Who is responsible for good corporate governance? So the main people who will be monitoring on behalf of all the shareholders is your board of directors. They are the main responsible body for corporate governance. So in that, you have to ensure that everything is conducted ethically in a proper manner. So the shareholders appoint a board of directors, so they will be overlooking all managerial activities. Next, financial statements should be prepared in accordance with. Next, here the financial statements should be prepared in accordance with. It should be you to prepare in accordance with all your accounting standards. Keep that in mind. So you have to adhere to whatever the standards that had been given by the Chartered Accountants Committee, not through auditing standards, not through concepts. The conceptual framework also come under LKS 1, accounting standards. Next, you have the code of ethics. Ethics 2016 issued by the CA Sri Lanka. The 5 principles that a professional accountant should comply to. The 5 main principles are, so we haven't done this part before. You have to, when you're conducting accounts, you have to conduct with integrity. Integrity means You have to be, you can't be biased basically. You have to be honest, honesty. Next, objectivity. Yeah, you have to do it with objectivity also. And it should be professional competence and due care. So what that means is, as an accountant, you should have the necessary knowledge to do so. And also, you should make confidentiality. Confidentiality. So what that means is, you can't give information to outside sources. And you have to be professionalism. That's also those are the 5 principles that have been given for accountants in the code of ethics. So it should be answer number B for 25. Next 26 we have, which the following option is correct to complete the below sentence. The prevention and detection of fraud in a company is the responsibility of. It should be so to prevent anything happening, it should be the main responsibility of your management. Your management should ensure that any fraud related activities are not happening in the company. Next, which is the following are correct relation definition of expenses as per conceptual framework. Assets are decreased due to expenses. That is so. Assets reduce. When you are settling an expense, you might have to pay in cash. Liabilities are decreased. That is wrong. This would increase liabilities. Equity reduces only due to expense. That is also wrong. It will reduce due to drawing cost. Drawing cost will reduce your equity. So here it should be answer number 1. These are wrong. Next, 28, which the following statement is not a supplementary source of providing financial information for a business entity. So, here a supplementary source that doesn't provide information is integrated reports will provide. Management providing the information also will provide. Sustainability will also provide, but through cash budgets, you can't get any information basically. After that, we have to drag and drop. So you get these types of questions also there exam. We have to drag and drop internal users and external users. So here, providers of finance. So that will be from people outside, right? So A would come under external users. The public is also coming from outside, right? Outside the organization. Board of directors. No, sorry, this is B, yeah. C, board of directors, internal users, people inside the organization. Trade creditors also outside, external users. So like this, you get as well to drag and drop. Then we'll move on to the next few questions. Which is the following is not a measurement basis for elements of financial statements as conceptual framework. So you have fair value. You can measure at fair value. That is the amount that you can exchange it for. You do measure at historical value, also at current value. There is no such thing called recoverable value. You don't measure at that value. That should be the answer. 31, which of the following parties are primary users of financial statements? So as I told you, it should be potential investors, lenders, and other creditors. They are the main parties who will be using your information. Customers don't use. Here, tax authorities won't go. They'll go through, but employees, government also won't care. But mainly these parties will care. Your potential investors, lenders, and other creditors. 32, which is the following statements are correct in relation to importance of maintaining financial records in a business entity. So we have to identify what is true to comply with laws and other regulations. Yeah. So when we are maintaining records, we should comply with the relevant laws and regulations that have been implemented. It will help us to control business activities. That is also true. To prepare financial statements to provide information for decision making. That is also true. No? So here 32 should be answer number C. All three are correct. Next, what is the final output of financial accounting process? So I hope you remember the process that I have explained. So in that, the final process is where you make your financial statement. That is the output at the end. So that's what you publish. Your income statement and your SOS. Move on to the next question. Then. So 34, which of the following is not a disadvantage of a limited liability company? They are asking what is not a disadvantage. So then they are asking basically what is the advantage in having separate legal entity, raising finance is easier, not a disadvantage. It says what is not an advantage. So opposite of what I said. So basically they are asking what is the disadvantage. Having a separate legal entity, that is an advantage. Raising finance is easier. You can issue shares and get capital. And you also have a limited liability for the money that you have invested. So basically, if you have invested in a company, if the company is bankrupt, you will only lose that money. Okay. And high legal and legal accounting requirements, that is a disadvantage because you have to adhere to so many rules and regulations. Next, which of the following statements are true in relation to financial accounting? The legal form of a transaction should be taken into consideration over the commercial when recording transactions. The commercial substance of the transaction should be taken into consideration over the legal form when recording transactions. So 35, it should be you take the commercial form of a transaction over the legal form. What had actually happened? So here it should be 2 is only correct. You don't take the legal form over the commercial form. This should be answer number B. As per the code of ethics issued by the Institute Charge of Accountants, being straightforward and honest, as I told you, it should be being honest is, as I told you, it should be integrity. So being honest, integrated. Next, you have consider the following statements. You identify whether this is true or false. Directors are responsible for preparation of financial statements, and financial statements help the company only for internal decision making. No, that is false, right? So here, directors are responsible to prepare financial statements. That is correct. And financial statements help to the company only for internal decision making. No, people outside also will take decisions, right? People outside the organization. So external also counts. Internal and external both. Next, one purpose of accounting information is to enable users to assess the performance of a company. Which of the following groups is likely to receive a profit related bonuses? So here, profit related bonuses. Now, if the company is doing well, keep in mind, competitors won't get anything. Suppliers also won't get. Community also won't get, but managers will get a bonus. No? If the company has done really well, The company might pay out bonuses to your managers or employees, whoever. Then we can move on to the next section or the next set of questions that we have. So next we have drag and drop. Accounting principles, we have a space. Has eliminated all weaknesses of accounting practices. There's no such thing like that. There's always some weakness. Accounting rules formulated by professional institutions. No, those are accounting standards. No? Are sounded in theory but rarely used in practice. No, you actually use it as well in real life. Then are procedures that companies must follow when they comply with their finance statements. That is true. No? You have to follow relevant accounting principles. 40. Which of the following groups uses accounting information primarily to help protecting your public? So the main organization will be regulatory agencies who regulate certain rules and regulations. They are doing that so that no harm happens to your public when they come and invest in your company or something. So these regulatory agencies set certain rules and regulations for companies to follow. So no unethical activities happen basically. We'll move on to the next set of questions. Next we have the following characteristics of financial information as per conceptual framework for financial reporting explains the ability of information to confirm or correct past evaluation have been made. So it should be to confirm value and confirmatory and predict future outcomes. As I told you, we came across this before also, it should be relevance. So relevance, it will be helpful for stakeholders to take decisions. Next we have, which is the following is the underlying assumption in preparing financial statements. So as I told you, we came across this before also. Main underlying assumption is your going concern. We should run with the intention of continue. Current value includes so here current value measurement basis includes basically your present value and also your fair value. Current value will include present value and the amount that you can exchange it for. Basically present value is the value at the moment. Fair value is the amount that you can exchange it for. Okay. Next you have, as to the conceptual framework, the primary uses of general purpose financial statements are your existing and potential investors, and here employees don't come, customers don't come, employees don't come, so it should be potential investors and lenders. Answer number B. And now in your new syllabus you have other creditors also, and other creditors. Which is the following is not a contributory factor towards faithful representation. So we came across this before also. This should be complete when you're publishing your financial statements. The statement should be completed, and you try and minimize the error, and you can't be biased. This doesn't come. A doesn't come. Next you have which of the statements are relevant to describe an income. So income is an increase in asset, decrease in liability, which should lead to decrease in equity. It should be answer number A. Other stuff are wrong. Here decrease in asset, increase in liability, that's an expense. Include contributions from holders to equity claims. So those Those are the elements that affect the equity. Not include the contributions from holders equity claims. So that doesn't. Here we have to select what are the correct answers. No? So here. Here A comes. Now that would affect the equity, right? So it includes contribution from holders, 46. So 46 if you take, which is the statements are relevant to describe an income. Here it is an increase in asset, decrease in liability, which result in increase in equity. That is true, because due to an income, maybe you get more cash, so assets will increase and your liabilities will reduce. Decrease in asset, increase in liability, that is an expense. So B doesn't come. Include contribution from holders or equity claims. So what that means is it includes amount invested by the owner. Additional capital is not an income. So C doesn't come. Not include contribution from holders or equity claims. Yeah, it doesn't include, because you are getting this income from operations, right? So A and D, answer number B. Yeah, so these are some of the questions that you can practice. You can take your workbook out, go through this. Yeah, so make sure you watch the recordings, and then after that do these workbook questions. And I hope you have got an understanding how to do these questions. Now this is how you get in your exam basically.